Welcome to the Wealthworthy Podcast. I'm Trisha.
Hi, I'm Darian.
Thank you for joining us. This week we'll be talking about investing risk and really with the changes and fluctuations that we see in the market, we just want to be sure that, again, we have another layer of financial checkups and that you are paying attention to what you should be investing in, how you should be investing your money, whether or not it's time to pull dollars out of the market, right? So, considering all the different choices that you have around your investments and just what makes the most sense for your long term strategy. So, knowing that the market is volatile, there are tons of opinions on how much money you should have invested and which instruments you should look at to continue your investments. When it comes to spending money, you really want to be sure that your long term strategy is aligned with whatever instruments you're choosing. So if you decide that you want to be a part owner in stocks, right, related to different companies, then you have to be there for the bumps and bruises in order to avoid missing any large jumps that could happen with those companies or the company that you're interested in. So, one of the biggest issues is just the fact that people tend to pull their money out when they see signs of any decline. And then within a few months, that same stock can triple or, just be back on an upward trend. And now you've missed out. You've lost money because you bought it when it was going down, and then you lost money because you've now missed the opportunity to take advantage of that upward tick. So, Darian and I have been kind of talking through what makes sense for our own investment strategies because we've seen a number of people opt to put large sums into the market, right? Because it's like, ooh, there's a sale, let's throw out our money into this. And while that could be a great strategy if you are in a financially sound situation where you have ample savings beyond what you need for any near-term emergency and you can afford to put more into the market, that's completely fine. But with the uncertainty of what people's job situations will look like, whether or not you'll need the money in the near term, it makes it more difficult to invest and have it be a longer term situation. So, any thoughts that you have on this?
I think when it comes to investing, you just have to be smart and make sure whatever risk you're taking, you can live with the outcome. Because sometimes I think people invest certain amounts of money, and then if you lose 50% of whatever you invested, sometimes it's hard to come back from that.
Yeah, and I mean, I think that it causes a certain amount of pressure too if you are making investments, especially if you're using techniques like buying on margin or doing option trading, where now you are in many ways leveraging money that you don't have readily available, right? It could cause added stress. And the point of living a wealthier lifestyle is not to feel additional stress, right? You're not aiming to create more problems for yourself. So you really do have to be strategic about how you invest your money in the market and what decisions make the most sense for you. So, when it comes to the choices of investing in individual stocks versus investing in broader mutual fund, index fund, ETF type of instruments, those decisions are aligned with the kinds of risks that you're willing to take. So, if you are gung ho that Zoom stock is going to continue increasing based on the fact that people are more dependent on remote technologies, then you may be tempted to take a long strategy and go ahead and buy it at whatever price it is now, under the guise that it'll continue going up. And that may work out great, but at the same time, it may be something that is more risky than you're willing to accept. So, a number of individual stocks on the market right now, many people feel that they're overpriced, overvalued, which means that at any given time, if the market corrects, it may lower the price, and then you would have paid a much higher price for it than people feel it's worth now, right? So you don't want to be caught in that type of situation. And if that's the kind of downward trend that you start to see, that's when people are quick to sell off, right? But the goal is that you have done some research to know that Zoom stock is doing better because there are specific actions that the company is taking versus blindly investing because somebody else told you to, or because you see that it seems to be going up, but you have no idea how that compares to their actual value. When it comes to investing in more broad-based, diversified instruments like an index fund, you really are looking at more than one company, which mitigates some of the risk, right? But it doesn't take all the risk away because you really don't know how the market's going to perform. You don't know how those companies are going to perform. But you can feel more confident that if you enjoy certain types of companies, so if you wanted to invest in a tech sector fund, you can invest in multiple technology related companies without having to feel the pressure of just that one, right? So just trying to figure out how to even out your portfolio, diversify your portfolio without taking away your chances at reaping the benefits if a company that you are interested in goes up. So I think the biggest thing for me at this point is just like, yes, you can take risk on companies that you are excited about, but you do have to be wary that by the time you find out about any individual company and their performance, they've already made somebody else rich, right? So you don't want to be caught up in just getting the scraps and getting the aftermath. Like, you really have to be proactive about your search, particularly if you are going to invest in individual companies. You have to be very active in knowing what's going on in the market, knowing who's running the company, knowing how they're spending their money, looking at the different indicators like PE ratio and earnings per share to help you know whether or not it's a good investment. And even then, right, that saying that past performance is not indicative of future performance, they say that because things can take a huge turn from what it looks like on paper to what the new reality becomes. And even like the fact that we're in this situation with the coronavirus, most people weren't anticipating that happening and didn't plan for it in their investments at all because that wasn't something that you were conscious of happening right away. And so now companies that were completely solvent are in a situation where they have to figure out how to operate. And some people have been okay at turning that around, making it an online business. But if your business isn't an online model, right, how do you turn that around? So sometimes you have to figure out what the unexpected looks like and what you think you can trust at this point, right? Like which voices can you trust, which articles, which team members, right? Like really figuring out and pinpointing the things that you are interested in about any specific company so that you know whether or not you should go forward with whichever firms you're choosing. Any other thoughts there?
You just have to trust your process. 'Cause either way you look at it, you're taking a risk. One way or another, it's just which type of risk are you going to take.
Yeah. And it is a trade off. So you have to think about what else you could be doing with your funds and how that would impact your investing strategy. So if you had already earmarked these dollars to invest in the market under the assumption that you're looking to earn more than 5-6% on your money, then you have to reevaluate and say, is this still the case? Do I still think that whatever I'm investing in here will give me the kind of return that I'm looking for? And if the answer is yes, it may still be an investment worth pursuing. If the answer is no, what other things could you be doing that would offer you the same kind of return that you were looking at? So whether that's looking to real estate or looking to open up the e-store or starting a completely different kind of business, starting a couple of side hustles, right? Like just figuring out what type of things you could be doing with your funds that would offer you some kind of return down the line. So when it comes to investing in the stock market, you really are trying to figure out how to beat certain indexes, especially the S&P 500 and other instruments that you might want to benchmark against. So if you're like, yeah, I could easily get 10% by investing in my friend's company or in this specific kind of fund, then you can compare that to see like, well, what is the S&P 500 offering right now, and is my other opportunity better or worse? So just be active on making sure that whatever you're doing with your funds can offer you the kind of return you're looking for. Another thing that I would want to be conscious of is just investments in companies that you know are trending downward, right? So right now there's been a lot of talk about airline companies. A lot of people are investing in these airlines because the stock is cheap right now. And it's great that it's cheap, because if you're thinking, oh, this something is on sale, let me get more of it. But the distinction is whether or not the company is actually on sale versus they're going through bankruptcy or they don't have a good turnaround strategy, right? Sometimes companies go into bankruptcy and they emerge as a stronger player, but figuring out the distinction between those two scenarios is a tough task, and you really have to do some digging to find out if that's the case. So in this case, I think many people see it as like the coronavirus temporarily making people less mobile than they were before. So as soon as we can be mobile, the company will do better. And there's a good chance that that's true for many things, but whether or not that means that the stock price will rise to match what it was before is a different question. So you have to figure out whether or not you can trust the growth strategies that the management has in place. And then you have to also figure out if they have a plan to turn around their earnings. So how are they going to improve their earnings, and is that going to translate into more money for you? So things that help you know if they have a good strategy for improving their earnings is going to be like how much are they spending on research and development? How much are they spending on learning new technologies, right? So those all go hand in hand for you to know if they're looking at opportunities for them to come up with new products. Then there are things like getting a new board member or getting a new executive team, right? Like are they changing up their leadership in ways that will be beneficial to them? The existing leadership may be great, and you may not need to touch that at all, right? But you do need to know if that's something you're on board with. Like, oh, I trust that this leadership can help the company emerge as a stronger player. And then, of course, you want to know if there are changes in the industry as a whole that could impact you as well. So just being conscious of the things going on around each individual company, each sector, and being able to compare the different companies to find out what makes the most sense and which are the stronger players today, and whether you think that'll be the same down the line. So when it comes to just like how much money you should invest, what are your thoughts about that, Darian?
It really just depends on the person and the amount of money they want to spend. Some people believe in investing a lot. Some people believe in investing a little. It just depends on the person and how much they have saved up and kind of like how they want to spend their money. I think that can be tough because everyone spends their money how they feel fit. So with that being said, again, it's just about making smart decisions and kind of, I want to say playing it safe, but being okay with whatever you decide to invest. I think if you can break even, that's good. But I think when you don't break even, that's when you have issues. I think personally, my investing style is I play it a little safe, but that works for me. It's worked so far. So, like I said, it just depends on the individual.
I think playing it safe means that your money isn't going to grow as quickly as you might want it to, right? But you have to figure out what your growth strategy even looks like. So if you're comfortable, if your goal is to keep a comfortable growth rate year over year, then that means that you have priced in the amount that you could be losing by not taking a larger risk. So, for example, leaving your money in a bank account versus putting it into a treasury fund, right? Like you may get slightly more money for putting it in a treasury fund than you would putting it in a bank account, but your money is still relatively safe. But then if you take that and say, okay, instead of putting my money in a bank account, I want to invest all my money in Apple, then now you're putting all of your eggs in that one basket, and it's determinant on it, like it'll be dependent on the performance of that company. And now you have to be concerned about the things that Tim Cook is doing and what kind of innovation they have and what kind of returns they've had in the past and what you think they'll do in the future. And so you have to be more cognizant of that. And depending on how much money you put in, you might have a hard time sleeping when you see some of these ebbs and flows happening in the market. So just be conscious of how much you have available. For me, I feel comfortable once I have my emergency fund, but then also knowing that I have dollars set aside for any near-term transactions that I'd want to make, right? So, like, oh, there might be some bills that come up that you knew were coming, but it's not a monthly recurring kind of expense. Or, something happens around the house and you might need to pay for it really quickly. You don't want to just dip into your emergency fund for that. You still need to have money readily available to cover expenses like that. So I feel comfortable once I have the emergency fund plus some cushion to allow me room to cover those kind of expenses that may come up, or just if investing opportunities come up. Like, that is the pool of money that I would reserve to do that kind of thing. And even when we talk about donations and things of that sort, anything that kind of comes up, those are the funds that you want to be able to pull from. And then everything beyond that, you can look at what saving vehicles make the most sense for what you're trying to do. If you don't think you'll need that money for the next couple of years, then putting it in the stock market may be a good idea. If it's something that you think, like, hey, I might need it within the next year or two, then maybe looking at specific types of accounts, or looking at specific things where you're okay with just getting a couple $100,000, depending on how much you're investing, and then you'll be fine moving forward with your plans, right? So if you're looking to buy a house, or you need to buy a vehicle, like, those are larger purchases that require more planning, and you don't want to risk your money being worth half of what it is now if in the next year you're gonna need it. So just being conscious of those things, I think, is important to figure out what risk level you're okay with. Which is why when we talk about the stock market, we talk a lot about using these index funds and ETFs as ways for you to easily diversify and still be able to invest in the companies that you're most interested in, or just being able to capture the growth that the market has been experiencing. So obviously right now, just based on the last few days, we've seen some increases and decreases happening in the market at the same time. But we're really in this for a longer term strategy. So you can't just go based on one day. You really need to understand what the last few months have looked like, what's the last year look like, and then think through how this situation could possibly impact the things that we're looking to do. So how long are we going to be in this situation? And is investor confidence really back to a more normal state right now? Or is there still some trepidation around everything going on with the election, everything going on with the companies that have filed for bankruptcy or may not be able to pay their employees in the next month or two, right? Like, we have to figure out and factor in all those things when we look at what the risk is for our next investments. So please just take the time to make sure you consider those risk factors before deciding to put all of your funds into a stock that's going bankrupt, a stock that somebody else told you is going to go up in the next couple of months, or, just something that might have made money for them in the past, but there's no indication that you'll be making the same kind of money if you invest your dollars. So please, please, please just be mindful and be cautious about your next investment move. All right. Thank you guys for listening. And until next time, bye. Bye.